Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guest's organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Hi, I'm Matt Heiner, Joint Managing Director of Net Wealth, and welcome to Between Meetings. In this podcast series, I chat to industry professionals and thought leaders on what made their careers successful and the opportunities and challenges they see on a wide range of topics as they relate to the delivery of advice and financial services. I hope you enjoy their unique insights. In this episode, Sarah Brennan, CEO of Investment Trends, shares her journey into the finance industry, what prompted her to set up her own benchmarking business, and why she's excited to be the new CEO of Investment Trends. We chat through the changing face of advice business models, the explosion of online broking, and what advisors can do to position themselves for millennial investors. We also discussed the growing importance of ESG, building trust, and what we can learn from overseas. I hope you enjoy the episode as much as I did. Hi, Sarah. Welcome to the show.
Thanks, Matt. Thanks for having me.
So this is a little bit different. We're back to, I think we were about 12 months ago from a recording perspective. Sarah's at home. I'm in the office, which it hasn't happened for about 3 months, actually. So apologies up front for the sound quality, but thanks for making the time.
No, it's a pleasure. And as you say, we sort of have reversed roles. I think I'm in New South Wales, so we're sort of going into lockdown. You're in Victoria, you're coming out.
Let's hope that this is the last one for forever, or at least for a very long time.
Agreed.
Sarah, we've known each other for a long time. I don't even, might be 10 years, possibly longer. But I'd be fascinated, as I'm sure the listeners would be, if you could just give us a little bit of your history, how you got into the industry, and more importantly, how you ended up actually in your current role and the focus on research.
I was actually thinking about that, Matt, how long we've known each other. And I think it's probably about 15 years, which is a bit scary. So we must have met when we were very young, obviously.
Absolutely.
Because we're obviously both still incredibly young. But to answer your question, how I got involved in the industry, I started in a call center with MLC when I was at university. So I was studying at university, typical university student, didn't have any money, had the opportunity to work with MLC in the call center, initially making outbound phone calls to people. I think at that time talking to them about unit trusts, which were like a very new, exciting thing in the industry at the time, which probably dates me a little bit. But then after I left university, I actually stayed on with MLC in the call center. And can I say, for anyone interested in sort of joining the financial services industry, your kids or grandkids, etc., you can't get a better grounding. And I am so grateful that I did that, because you get that understanding of the history of the industry. And you also get that understanding of consumers and super members. So you're talking to real people about the issues that are sort of affecting them. And I remember getting calls where someone's mother or father had died, or someone was going on to claim, or they were retiring and they were getting their superannuation benefit. And I have to say that shaped sort of everything I've done since then, because it really gave me that client, that consumer, that member perspective on things.
I think that's a really interesting point, because so many of us operate from, I guess, the institutional funds management land in a B2B world. So you don't necessarily get that contact with the end customer whose money you're actually managing or investing.
Yeah, exactly. And I think also in the call center, that's where I got my first exposure to advisors as well, because a lot of advisors would be ringing, asking questions. And again, you got that great grounding in understanding, how important it was to them to be able to get them the information quickly, and also an appreciation of the value that they were actually adding to their clients. As I said, just a fantastic grounding. So that's how I got into the industry. And then I sort of moved through various roles in product management, particularly around retirement income, which was then and continues to be a hot topic and a fascinating topic. One I could spend hours on, but most people don't want to hear me spend hours on it. And so focused on product management, and then moved through various roles. My final sort of corporate role was as Chief Operating Officer for Asia Pacific for Deutsche Bank. And that was sort of looking after sort of all of the broking clients, looking after funds management, looking after margin lending, and also financial planning. So a fantastic sort of breadth of understanding in the sector. And that was sort of the final corporate role I had before I started our own business.
Okay. And in the 15 years or so that we've known each other, the industry's obviously gone through huge change. Reflecting on your time over sort of 15 years, what are some of the really good things that you think, unfortunately, have left the industry? And what are the things that you're really pleased to see coming into the industry as we move to a profession?
Yeah, I think some of the things that have left the industry are some of the poor, and I hesitate to use the word, but the poor sort of sales practices, and they really were sales practices. So I've been in the industry a long time and seen some of the outcomes to clients where they weren't really receiving advice; they were being sold product, and perhaps that product was not really in their best interest. And unfortunately, I've seen some of that. So in a way, I know, perhaps, the regulation has sort of moved a long way. And some, can say sometimes the bar swings too far. But some of those bad sales practices, you're seeing that leave the industry has been fantastic. And I think, I'm not sure if it's seeing it leave or it's seeing it come, but one of the things that I think has been fantastic is the move of advice to being a profession versus, and we're still on that journey. I get that, but that, and I know education standards a challenge at the moment, obviously moving through for Sarah, etc. But that move to a profession and one of my great passions, I think, as you know, Matt, is advice and the value of advice. And what really frustrated me was the fact that, we had so many people out there doing fantastic things and there was a few not doing the right thing. And unfortunately, that tainted the sector. And that's why I'm so pleased to sort of hopefully see that sort of behavior leave the industry so that the majority who are doing fantastic work have the ability to shine.
So we might come back to that point in a little bit. I'm interested to understand what was it that motivated you to leave the safety of a big institution? I think you said it was Deutsche Bank at the time, to set up your own business and to set up your own business doing something that was, from what I understand, very different to your background.
Yeah, it's a good point. And it's an interesting, because a lot of people say to me, it's very courageous to go and set up your own business. And hey, you guys, that's exactly what you've done. And it is courageous. I think you were probably more courageous than me because mine wasn't that courageous because we set up our own business, but we consulted straight back to Deutsche Bank. So I had a bit of a safety net there. But actually what prompted it was I was traveling an awful lot at the time in my role. As were my colleagues. And we were at a point where I wanted to start a family and travel and family just didn't work. So the opportunity to set up my own business really came from that. And unfortunately, with a number of colleagues, we left Deutsche Bank at the same time. And you're right, we set up a benchmarking business. And it was interesting. It actually came about where I was on the board of the Financial Planning Association at the time. And I was sitting between two licensee heads who were also on the board at a dinner, and they were talking across me and they were comparing their businesses. And I knew both of their businesses quite well, and they were both perhaps not telling the exact truth. And I sort of said to them, I called them on it and said, I don't think that's quite right. And they said, well, why don't you, set up a business where we can compare our businesses and we can benchmark ourselves against each other, but do it in an anonymous fashion. And that's how the idea was born. So we started benchmarking licensees on all of their business metrics and then platforms, and it sort of grew from there. So it was sort of serendipitous the way that the business evolved.
And how long did you run that business for?
So that business was comparator benchmarking, and we ran that for about 15 years. Maybe 10 15 years, and over that time grew it to sort of benchmark across both the wealth sector as well as benchmarking across banking and trading type sectors as well.
And platforms, which is where we first met.
Exactly, and platforms, which was fantastic. And actually, when we first started benchmarking, we were just benchmarking sort of the platform space, and then we grew that also to incorporate the industry superannuation space as well, so that we were sort of benchmarking platforms and then all of the super sector, which also picked up platforms. So incredibly sort of privileged position in the industry, Matt, that we could sort of sit in the middle, have access to all of this amazing data, and then be able to present back to people such as yourselves, your exec committees and boards, and share some of the insights about how platforms were performing compared to each other, and I guess identify opportunities as well, which was just loved.
And I think it's a good point you raised about being a privileged position. Obviously, when we got the research, and at the time, we also ran a licensee, so I think we participated in the licensee research. So we got the information on an anonymised basis, but being able to sit there and actually see the business models from the inside out must have been fascinating, particularly given that the industry at that time was very much product subsidised. To be able to see that shift from a product-led advice industry through to an advice-led industry, what were some of the key things that you saw happening probably over the last 5-10 years?
Yeah, no, it's a very good question. It's very true. I recall when we first started benchmarking licensees, one of the key metrics that we had was investment sales per advisor and insurance sales per advisor. Now we look at that and go, seriously, is that really what we were measuring? But at the time, none of us sort of, no one thought that was the wrong thing to measure. That's what people wanted to measure. So what we've obviously seen, so that was the product led. What we have seen, as we've all seen, is that just that evolution to being advice led. And I used to always be fascinated. People used to draw value chains, and they'd always start with the client was always sort of at the end. And I was going, you've got to put the client at the beginning. But I think that's now what we've done. We've seen that move. And I know with the work we now do in the research I do today with investment trends, it's all about it's advice led, it's about the consumer, and it's about, having said that, it's also about the advisor, don't get me wrong, because it's okay, how do we support advisors to be able to do what they do for consumers is sort of the way I guess I've seen that evolution of supporting advisors to support their clients, not support advisors to sell more product, if that makes sense.
So it might seem like a strange question, but you mentioned again that the client should start at the start of the value chain. Licensees have limited levers to pull when it comes to revenue generation.
Yeah.
What the successful groups that you're seeing now, how have they restructured their businesses, and what's their business model or financial model moving forward, other than just taking a percentage of revenue?
Yeah, I think that the key things I guess we're seeing is in the advice space. One is obviously the whole issue of the fees that you are charging. So it's old news, obviously, that we charge fee for service, but it's actually being able to charge the right fee. And so I think that's taken a little bit of time. And I think it's still evolving, because I think we probably share the view, what planners do is incredibly valuable. But because we grew up from this product environment where advice was free, and I still you think back to the ads that were run that said come and get a free advice. That
Health
didn't
check.
help. Health check, or we do free advice. That devalues advice, and so I think we're still, we've moved a long way, but there's still more to go. That what advisors do is incredibly valuable. So actually, charging the right fee for both upfront and ongoing service is absolutely key, and to be doing that. Confidently, I guess, knowing the value that's added. So that's obviously one area that's incredibly important. The other, I guess, is we've seen advisors, obviously, because of that, look at the clients that they are looking after. So the whole segmentation, do you want to look after, in the high net worth space and you have less clients, again, charging the appropriate fee. We're seeing people, maybe in that middle space where it's using more digitized means to support their clients. So be able to deal with greater scale because of the advent of digitization. So that's sort of, that different sort of segments that we're seeing. And then probably the other area that we're seeing is practices and licensees who are sort of also moving into sort of the portfolio construction space, and in that space, I talk around managed accounts, etc., that they can provide to their clients, but be able to add that value around that portfolio construction side.
And in that regard, from a licensee perspective, we've seen, I guess, licensee costs obviously creep up pretty significantly over the last 4 to 5 years as rebates and other product-generated margins disappeared. Do you have a feel for what an appropriate level of fees are these days for a licensee to deliver services to their advisors? Is it $40,000, $50,000, $60,000?
Yeah, it's a good question. I don't have a view on the exact fee, and the reason I'm sort of smiling when I say that is that we're about to actually undertake a license through Investment Trends, a licensee benchmarking study to actually ascertain exactly that. Because I think it is a question at the moment is, what is that fee that is being charged to the practice and to the clients on a comparable basis, which is always quite challenging. And that's the beauty of what we do is we've got the methodologies to be able to get a like with like comparison, but also what's it costing the licensee to actually provide those services. So, we can look at what's actually being charged to the advisor and the practice, but you've also got to look at the other side is what's it actually costing you to provide that service. So I don't know the number at the moment. I'd be guessing, and I think we all are at the moment because it's still evolving, and I don't think that sort of benchmarking exercise has been done for some time, which is why we're sort of excited to be going back into that space and to do exactly that. Compare licensee costs to the advisor and the practice, but then also be able to compare what it's actually costing you as a licensee to operate your business and how does that compare to your peers. So I think that it's going to be really cool. I'm really excited about that.
I will have to get you back in 6 months or so when you finish that.
Share
and
it.
obviously,
Yeah.
No doubt our listeners are welcome to buy the report if they're that way inclined.
Yeah, exactly. But I'd love to do that and come back and share it because I think, I don't know about you, and it's why I love what I do, which is research and stats based, that lots of people will say to me, I know that it's costing $40,000. And I say, but how do you know that? And it's, well, I've spoken to a few people and this is what, so the beauty of what we do is to deal in facts and say, well, this is what's happening. And for some, it is costing 40, for others it's costing 60, but let's ensure we're comparing apples with apples here. That's the challenge.
That's a good segue. So you're now the CEO of Investment Trends, having sold your previous business.
Yep.
You've been out of the market for 2 years, out of research anyway, and doing a whole lot of other interesting things in the meantime. Do you just give us, the listeners, a little bit of background to Investment Trends, why you're excited about the role and some of the research that you're currently doing outside of the licensee work?
Sure. So we sold our business, which was a little bit like giving away my baby. So I struggled with that a little bit, I have to say. And then having spent some time out of the industry, came in as CEO of Investment Trends a few months ago. And that was such a natural move for me because when we ran our benchmarking business, we often were sort of, side by side with Investment Trends. So always had a lot of time and respect for the work that Investment Trends did on the basis that it's very statistically driven. And that's key to me. I mentioned earlier about dealing in facts. So it's actually making sure that there's sort of method to the madness, I guess, in a way. I don't know if as a statistician you can say that. So Investment Trends, we sort of have two core components of areas that we conduct research on. One is trading behavior. So that's very much around the online broking world and the listed derivatives world, etc. And that, as you can imagine, is absolutely fascinating at the moment, having come through the last 12, 18 months of COVID, just the explosion in online broking and the people who are doing it. And I think it's a really, really, it's probably a whole podcast on its own of the implications for that for advisors in the longer run, because a lot of that group is that millennial group.
I was going to say,
coming in.
Might pause on that for a moment. It's something I'm a little bit passionate about at the moment because I think it's a train wreck waiting to happen. And I think the advertising that we're seeing or hearing on the radio and on billboards and on tram stops is actually quite concerning and something that advisors need to be very well aware of.
Yeah. Look, I couldn't agree with you more, Matt. There's just the number of people who come into the market, the age group of those people, the trading that they're doing, the sources of data, information that they're accessing. I think that Um, it's an area where greater education and for a lot of the online brokers, they're moving into that space now where there's a lot more education and a lot more support being provided. And that's one of the reasons why I guess the research we do in that space is quite important, identifying where that education is needed, etc.
Do you think that the growth in the millennial traders and in that cohort becoming interested in investing, obviously it's easy at the moment, everything's going up, everyone's making money. When things don't necessarily go as well as they are now, is that an opportunity, do you think, for advisors to not pick up the pieces, but to provide services to those now hopefully more financially capable clients or investors that are actually looking for professional advice?
I think it is, and I think I know you can sort of look at the downside, that a lot of people are coming in, are they fully informed, etc. But on the other side, I think, as I said, a lot of the online traders are doing some really good stuff around education, etc. And I think if you think about it, what we're having is a much more engaged group of people with their investments, and that's one of the things we've always talked about in Australia is people who've got an advisor value advice, but people who don't have an advisor don't know what they're not getting. Getting people engaged with their superannuation is always a topic that comes up, and it's not easy. And now we've suddenly got this group who've come through, and they've had the time through COVID to be doing research and learning, etc., who are actually quite engaged. And so, yes, I think over time that more engaged group become a huge opportunity for advisors. Absolutely.
But they're going to have to change their value proposition and become far more digital if they're going to succeed in that market.
Absolutely. And it's interesting. I heard a lady speaking the other day on a podcast that she was talking about, financial services digitization. And she was saying, and she was coming from a consumer goods perspective. And she said, in the consumer world, people just expect everything to be digital. And in financial services, we get excited when we digitize a statement. That's not digital. And she said, what people are looking for is the Uber sort of experience in a financial world. So I couldn't agree more. I think there's that opportunity to digitize as this generation comes through in particular is a huge opportunity for advisors.
Before we bring you the second part of this chat, a little bit about who we are. Celebrating over 20 years, NetWealth is an ASX-listed company that has been rated number 1 for overall user satisfaction by Investment Trends for 8 consecutive years in their Planner Technology Report. As the financial advice landscape changes, it's important to embrace new technology to enhance the way you run your business. With change comes your chance to innovate, explore new perspectives, and realize new efficiencies. NetWealth is here to support you on this journey by providing you market-leading technology, excellent customer support, and expertise to help your business thrive. Contact us today or visit the NetWealth website to learn more and get the PDS, which should be read before making a decision to purchase a NetWealth product. Products issued by NetWealth Investments Limited.
It'd be hard to talk about millennial investors and not mention Bitcoin. Any research or insights there?
Interestingly enough, at Investment Trends, we did look at doing a crypto study a couple of years ago, and we actually do have some crypto questions in our investor and advisor product needs studies. So there is some research there. It's still very small. We're actually looking at a crypto study at the moment because it's so topical. I think what's interesting is, again, in that market, you're seeing a degree of sophistication come through where some of these, people are educating themselves on this stuff. So I'll use an example. A friend of mine's son who's 21, 22, he and his mates sit around and they trade crypto, but he put $1,000 in, he made his $2,000, he took that out, and now he's playing with the money. So there, again, there's this education aspect is coming through. And I think what we're also seeing in crypto is the development of more sophisticated products. So we're actually seeing baskets of crypto now versus just putting your money on black, being Bitcoin or Dogecoin or whoever. So yeah, I think it's an interesting space. Again, I would come back to, if it's getting people engaged and educated from an advisor perspective over time, I think that's going to be beneficial.
Fantastic. And an age-old debate, active versus passive.
Look, it's a tricky one. Again, I'll go from the research, which is what we do. We ask consumers. We spend a lot of time talking about it in the industry. What we see in our research is consumers don't necessarily have a fully they don't know beta, alpha, etc. They're looking for, are you meeting my objectives? So the active passive. I'm an active person. That's my style. So I'll stay away from the debate. I'll get myself into trouble, Matt. What's your view?
Absolutely.
What's
I
your
don't
view?
have a view. I'm Switzerland.
All right, I'll join you in Switzerland. I could be
I think
Liechtenstein, just next door.
Perfect. And some of the other research that you're working on, I know you've got a very broad set of reports out at the moment.
Yeah, look, we've got some great reports out at the moment. I would say that, of course, but we do. One in particular, there's a couple I would mention which might be of interest to your advisors. We've just released an ESG report. So when you say the age-old debate, active passive, I think the hot topic at the moment is ESG. And we've just released what I think is probably the first of its kind in level of depth and coverage in Australia in the ESG space. And in that, we've researched both the consumer side as well as the advisor side. So we've got both sides of sort of the equation, I guess. So that is an absolutely fascinating report, because from a consumer perspective, what we're seeing is there's a percentage already who are, of the view that they are investing based on ESG principles. But what's fascinating is what we call the next wave. And there's quite a large group of investors. So we're talking very much in people who are investors who are coming through, who are looking for ESG type investments or ESG aligned investments. So it's not going away. It's this wave is coming through. And what's interesting that the research showed is that clients are leading a lot of the conversations at the moment, not so much the advisors, and clients are leading them in particular around climate. So when we look at the E and the S and the S and the G are sort of important, but the E is really what is front and center. And what the research does is it actually links back to people's personal behaviors and approaches to life, and links that to their investment. So, if you are, and that's where the E comes through quite strongly. So if you are, very much on renewable energy, etc., then you're going to be looking for that E in your investment portfolio. So that's that's a really, really, really key piece of research at the moment. It's the first time we've done it, and we'll be doing that, sort of on a regular basis now, but incredibly beneficial for advisors and clients.
Certainly an area that we're seeing huge growth in, as you would be through the research, and whilst it's certainly been a theme for 5 or so years, we found that the number of inquiries from consumers and also advisors spiked after the bushfires, which ties in very well with your commentary on the climate.
Absolutely. And interestingly, COVID didn't spike it anymore. So it was really the bushfires and then, the climate summits, etc., which has had the influence. But one of the things I find fascinating about ESG from a consumer perspective and an advisor is when you look at one of the questions we ask is, what percentage of your portfolio is currently ESG aligned? And what would you like it to be? And we ask the same for advisors. And what's interesting at the moment is when they answer that question, is ESG sort of being considered a little bit at the moment like an asset class, which is sort of fascinating in a way, because ESG is a type of investing, obviously, and whether it's bonds or cash or equities or etc., it can be still ESG aligned. But I think as we're evolving, as I said, it's still a little bit, I'll put 25% in an ESG aligned investment and just see how it goes, sort of thing, which is sort of, I find that quite curious. And I think that is something that will evolve over time. So that's a great piece of research. I love that. It's a really, really interesting topic. The other sort of key pieces of research is our advisor study, which was just released. It will be released this next week, just pre-30 June. And that's all about sort of the advice space. So what are consumers saying about advisors? What do they want? What do they need, etc. So for advisors and licensees, that's a really, really key piece of research. And then the other obviously one that we released recently is the platform study, which Net Wealth came through, as always, incredibly strongly in. So congratulations, fantastic results. Some great innovations of things that you guys have introduced and are working on, which again, with our lens, we're very privileged to sort of see what you're doing and see how that compares. So yeah, congratulations on an amazing result again.
Thank you very much. Sarah, with the advisor report that's coming out in the next week or two, without giving away all your secrets, are there any early findings that you can share with us?
I think probably the key thing is that we're seeing the demand for advice increase. And I think, it's probably not a surprise, but it comes to our earlier comments, I think, Matt, about how do we service clients. So that's, the different segments and the opportunities around digitization and different levels of service, different approaches, etc. So that would be sort of probably the first thing that I would point to. The only other thing is, I think, fees and the issue of, we touched on this earlier, of what you're charging, what's being charged to clients. While it's important, it's not the driving factor for clients. So while we probably, I don't know about you, I'm always terrible about talking about money and asking people to pay for things. Consumers aren't so hooked up on that. To them, it's about the outcome and the value, etc. So they're probably two messages that come through.
We've done quite a lot of work on this particular area as well in the recent times. Our research would suggest that there's around 2.2 million Australians that are open to advice that are currently unadvised. And the other interesting statistic that I think is being bounded around the industry is obviously the declining number of advisors, and that the likelihood that could drop to 13,000. So we've got a increasing demand, reducing supply, and I'd just be interested if those numbers resonate with some of the research you've done.
Yeah, they do, and that we've seen exactly the same thing, is that absolutely advisor numbers are coming down. It's interesting what the starting point was, and we won't go into that debate. It's a bit like active versus passive. What was the starting number? But the fact is, advisor numbers are coming down, so that is the case. And the demand, as I said, we're actually seeing that number increase from clients. What's interesting, though, is there's a little bit of a disconnect between, are you open to receiving advice? To your question, the answer is yes. But have you actually gone and sought it? And we have a big drop off. And so we go to the next stage and say, well, why not? Why haven't you done that? And the factor that comes through, and we talked about, is it cost? No. What comes through is trust. So that's the key aspect, is, being able to get out to the consumers to educate them on that value of advice and to keep building that trust. Because we also then go to a next question and say, what areas do you feel like you need advice on? And the list is extensive, and we end up with a high proportion of that group saying, well, 70% saying I need advice on these topics, but they haven't actually gone and sought advice yet. And the reason they haven't done that is trust is the key factor that is stopping them. And I have to say, that's not just with financial planners. We track who do you seek advice from, and that could be accountants, it's financial planners, independent through your super fund, etc. And across the board, probably not so much with accountants, but across the board, it's that trust aspect. So there's a disconnect there.
Trust is a huge topic, and it has many meanings. And I know that you do some fantastic cluster analysis. When you drill down on trust, what were some of the key things that came back from consumers as far as what would help give them belief in the advice or trust an advisor?
Yeah. One of the key ones, and this came out particularly, and we could really test this during the COVID period. One of the key ones that came out is that my advisor proactively, contacts me. So, when we looked at the trust levels and the satisfaction levels, where we had instances where advisors or platforms of fund managers, etc., but where people had actually proactively gone to the clients, that was a key aspect. So that comes through very strongly. So that proactiveness, if that's a word. The other aspect that comes through around trust is that they do what they say they will do. So that sort of comes through. And then the other trust aspect that comes through is around brand. And so being a brand, both in a negative and a positive sense, that I'm aware of and that I trust. And I think emerging is the education side. So, that I know the person I'm dealing with is well qualified. What is there things that you're seeing in, when you say it's a hot topic for trust, that you're seeing? Are there aspects that you're seeing come through, Matt?
No, I think that summarizes it really well. And
Cool.
the challenge for a lot of advisors now is also how do you build online trust?
Yeah.
Because the online footprint is becoming an increasing input into how someone feels about the brand. So it's interesting that you mentioned that.
Yeah.
And given that the industry is still in many ways a lot of small businesses, having or creating a brand that is has trust is actually very challenging. And a lot of that is actually on the online presence, what's happening on social. Are you releasing and providing a lot of content, and are you being proactive in your advice? So no, I think
Yeah.
it's very interesting.
And content is a really key. It came through very strongly across a whole lot. I guess the breadth of research we do is that demand for content, because we are in that online world. And what's interesting, it doesn't have to be. And we sort of talked about the fact that I'm recording from home, you're recording from the office, etc. It doesn't need to be, that sort of the big production that perhaps in the past, we maybe over-engineered what it needed to be. It's just being able to get out and talk to people, and podcasts like you're doing, Zoom meetings, just information sharing, links, etc. That appetite for content, I think is a digitization makes that a really it's open to everyone.
And we've got, and it's obviously not all about digital or technology. We still need to have that face-to-face, but we have our Advice Tech report coming out very soon, and it's going to be really interesting to see how the intentions of tech adoption have actually changed during COVID. Obviously, people have been forced into a virtual world. You mentioned before sort of revolutions in financial services, digital signatures, which really seems to be the biggest change that we've experienced in years. But how we actually adopt back to a face-to-face world, but keep the best bits of digital and find that right balance.
Yeah, and it's interesting you say that because we've just also completed our UK advisor report. And one of the things that came through in that was that the advisors and as in Australia, which we touched on earlier, margins have been compressing in the UK from an advisor perspective. But the groups who actually came through very strongly and performed well over the last 12 months were those who'd adopted a whole lot of that digitization. So, but they hadn't lost the personal touch. So to your point, it's that balance. But digital signatures and online meetings and etc. That those who digitized more definitely had a higher level of profitability in our cluster analysis. To your earlier question about clusters, but you're right, it's that balance. And I find myself, with talking to people like you when we're selling our research, you can talk via Zoom and Teams, but also having that personal interaction, it's important. So it's how do we get that balance? And I think that'll play out.
We're jumping around a little bit, but you mentioned the UK, which I think is a fascinating parallel to what's happening in Australia at the moment. We touched on the fact that advisor numbers are dropping. They might end up somewhere around 13,000. The UK went through RDR, which decimated the industry in many ways. Advisor numbers dropped from somewhere near, I think it was 100,000 down to about 20,000, but have subsequently rebounded. How is the UK looking at the moment in that regard?
Yeah, it's actually, well, as you say, it's rebounded, and it's actually it's continuing to grow. So it's sort of I don't think it's overstating. It's going strength to strength. COVID, as I said, was sort of a tough period, as it was for everyone. But the advisors who particularly have come through that strongly are advisors who have segmented their client bases. Who are charging fees for service, all the things we talked about earlier, and who have digitized. So when we looked at the clusters of particular advisor groups, the ones who'd struggled were the ones in particular, which I think we called sort of the traditional segment, who hadn't moved, hadn't probably addressed the value proposition with their fees and hadn't digitized. So yeah, I think it's interesting in the UK and the advice market, as you say, they sort of went through RDR a little bit, and had that drop off. I think, though, for example, in the platform space, we lead the UK when we look at our platform research between Australia and the UK. We talked about ESG earlier. ESG probably leads us. The UK leads us in the ESG space. So it's a great market to look at the parallels with.
If advisors are looking abroad, overseas, what are some of the other markets that you think are worth looking at? The US is obviously very digitized, and robo is growing at a rate of knots. Which are the most aligned to what we're going through at the moment, do you think?
Yeah, it's a good question. I think it probably would be the US. South Africa is always a really interesting market. Again, just because they've sort of mirrored, we've mirrored each other a bit as we've grown up as industries. So South Africa is a market I always look at with interest. From a digitization market, the market that I'm sort of really fascinated by at the moment is looking into Israel and what's happening in some of the places, in some of the sort of digitized digital hubs there. But that's not specific to financial services. Just some of the evolution that's going on is amazing, like just mind blowing. But yeah, so the probably UK and South Africa are probably the two.
Fantastic. Now, unfortunately, we're getting close to time, but before we finish, I did want to ask you about a mutual love of ours, which is skiing. Back in the day, I believe you're an Olympic skier, and I'm just fascinated to know what you took from that experience, other than becoming a very good skier, into your business life. What were some of the lessons you learned?
So yeah, I had many years skiing. I didn't quite make the Olympics, I have to say. I wish I had, but I was skiing. I was on the Australian ski team for many years, which was fantastic. What did I take? And it's interesting. Matt and I were chatting earlier that our kids are all skiing as well. And the reason I've encouraged them to do it is probably from what I took from it is you learn incredible resilience as a skier. You learn that, literally if you fall down, you get back up. I did a lot of that. And the other thing that I was incredibly lucky with is that I got to travel at a very young age independently with the ski team. So you had to learn to look after yourself and grow up and deal with things. And at the time, did I appreciate it? No. Do my children appreciate it today? I'm sure not. But if I look back now, I'm so grateful to my parents for the opportunity they gave me, that it gives you that grounding in, doing a sport that can be a bit tough, and you have to be pretty resilient. And I think that's the same in business. We all go through ups and downs, and I've definitely taken that lesson into to that. The other thing is probably from traveling. You learn that confidence, and as my children say, I will talk to anyone, anywhere, at any time.
Speaking of which, it's been an absolute pleasure talking as always. Thank you for fantastic insights, and look forward to catching up, hopefully in person soon. But thank you very much, and look forward to when we catch up next to talk about some of the new reports.
Fantastic, Matt, and again, thank you for the opportunity. Take care.
Thanks for listening to this episode of Between Meetings. For more episodes and to subscribe to our series, visit the NetWealth website, iTunes, Spotify, or your favourite listening service. And if you want to contact me or engage or discuss any of the topics raised, please find me on LinkedIn or Twitter or send me a private message. We hope you can tune into the next episode.